Welcome to another episode. My name is Jose Najarro, and today we're going to take a look at YEXT. So let's get started. So YEXT reported earnings today after hours, and it's up 10%. So in today's episode, we're going to take a look at the earnings report. We're also going to take a look at some articles, past performance of the stock, and I'm also going to end up giving my thoughts on the company. Just ahead, I am very bullish on YEXT. It is a strong revenue grower, so we're going to see how this company is doing. For those that don't know, YEXT is a company that they provide I did a previous video on YEXT that explains a lot more what this company does, but pretty much what a quick overview of what it does. It uses cloud-based networks. It uses artificial intelligence to be able to create like this perfect, it's not a search engine, but let's say if you go to Taco Bell's website and you put what is the lowest calorie, when you ask a specific question at tacobell.com, like what is the lowest calorie item you have, with YEXT, it will provide the best answer for you guys. So this is a business to business company where their customers are other businesses, and we're going to see this company has big names like Taco Bell, Subway, and other companies that are working with them to be able to improve their websites, to be able to provide the correct answers for customers. So let's just take a look at past results for YEXT. So here I am in Market Watch. In the past 5 days, this company has returned negative 5%. In the past, negative 7.5%. In the past month, negative 6.69%. In the past 3 months, negative 12%. Year to date is up 0.5%, and in the past year is down 26.32%. So we can see this company has been taking a huge beating since the past year, almost losing about a quarter of its market cap. So one thing I actually want to take a look at is when this company started trading. I know this is not too old of a company. This company only started trading in 2017, and in 2017 it opened up at about $13.41. So we can see we're not too far behind from when the company first started. All right, so let's take a look at earnings. Right, YEXT, they beat non-GAAP earnings. They have negative 12 cents loss, which was a surprise beat by 2 cents. This company was expected to lose a lot more money. And GAAP earnings per share were negative 27 cents, which beat by 4 cents. Again, this company was expected to lose more money. Next, we have revenue for this quarter of $81 million. Yes, $1 million. This company is a very small company. We usually see companies with revenue in the billions, but this one only has $81.3 million. But look at this. That's a 27% increase year to year on revenue, and it actually beat by 1.17 million dollars compared to that 81. That's about 1.5% beat, which is pretty good. Next, let's just take a look at the overall valuation of this company. This company is not expected to make money in 2020. It's not expected to make money on 2021. So actually, let me just take a look. This is their fourth quarter. So we are going to see an update on this eventually. But in 2021, this company is not expected to make money. The only good thing though we see is that this company is increasing. It's doing better on their losses. They have less losses each year. And we can see revenue for this company, 297. It did $300 million this year. And next year is expected to do $380 million. That's, again, full year revenue growth of over 20%. And that's, again, one of the main reasons I'm pretty happy to be doing this company. With a forward price to sale ratio of 4.5, that gives this valuation it's not that overpriced if we take a look based on revenue. Right, just like Mr. Wonderful says, anything over 10 is super expensive. But again, it depends on the company. If you guys watched my last video on Target and retail companies, usually with lower gross margins, tend to have a lot less. They have a forward price to sales ratio below 1. All right, so let's get started. This is a small company, so they have less information not less information, but they just have less slides. They don't have a slideshow like many other companies. They pretty much just give you results. So I went and highlighted all the important information. For the full year of 2020, this company increased revenue by 31%, 29.8 billion. And what was expected? It was expected $27.6 billion. So this company actually beat full year revenue by about $1 million. So that's good. Full year fiscal 2020 international revenue increased by 72% to $53 million. Unearned revenue increased 30% year over year to 176 million. And unearned revenue is exactly what it sounds like. It's revenue that this company has collected, but unfortunately has yet to provide the service for it. So this company has to first provide the service for it. So this revenue goes into actually the liabilities, because if this company doesn't provide that service, then they have to pay back that money. So that's why it's considered a liability. But every month this company does provide the service, that liability ends up going into the assets. And why would this happen for this company? This company has subscription-based services. So, right, this company might get paid for the full year, but they might have only done a full month's worth of work. So they still have to provide 11 more months full of work before they'll be able to truly collect all that revenue. Customer count increased 38% year over year to over 1,900 customers. And their structure facts, again, that platform they have, which is all the things, increased by 50% year over year, exceeding over 277 million facts. So now let's take a look at some highlights for the fourth quarter. So for the fourth quarter, revenue increased by 28%. Again, we're seeing that double-digit growth, and that's a big double-digit growth in both yearly and quarterly. Gross profits increased by 26%. Gross margins were 74.3% this year compared to 75.5% last year. So we did see a decrease in gross margins, which means this company is spending a little bit more money to get those sales. For the net loss, this company is burning money at the moment, and it has $30.6 million in net loss for this fourth quarter compared to $15.5 million last year. So they increased their loss by almost 100%, an extra $15 million. But they say that the main increase was driven to higher operating expenses due to an overall increase in employees. If you guys saw my last video, I did talk that this company is increasing its sales force dramatically compared to the same time last year because they want to get all these customers. So the best way to doing that is by increasing their sales force to be able to talk to more customers at the same time. The second thing is this company grew so big that it needed a new lease in New York City, but they're now paying for 2 buildings, even though 1 building is not being used. So that's another reason this company has higher operating expenses. If we take a look at net loss per share, it's 27 loss per share for this quarter compared to $15 same time last year. So this company does seem to be leveraging itself a little bit more and taking bigger losses this quarter compared to the same time last quarter. Remaining performance obligations ended up being $328 million for January 2020. And this money is expected to be recognized over the next 24 months is $309 million. So out of that $328 million, like I mentioned, this is money that they have to still perform the task at hand. And once they do, they'll be able to move this into their assets. And that's a pretty big number, and I'm happy to see that kind of number there. Net cash flow provided by activities was $117 million, was $11 million for the fourth quarter compared to $30.8 million same time last year. So this company is spending more money, but again, we saw this company did increase its sales force hugely compared to the same time last year. Now let's take a look at the full year of 2020. Revenue grew 31%. Gross profit grew 30%. So that's I always like to see that when revenue is growing by X amount of that percentage and gross profit is right behind it, right? Revenue increased 31%, gross profit increased 30%. Gross margins was 74.2% this year compared to 74.9% last year. we see a drop in gross margins, and that just means this company is spending more money to sell its products. But hey, it only dropped by about 770 basis points, which is not that much, but it's something to definitely take a look at. Net loss for the full year was $121 million compared to $74 million last year. And again, the main reasons were higher operating expenses due to overall increase of employees and that extra lease that I mentioned before. Non-GAAP net loss was $53.8 billion. So when we talk about non-GAAP, most of the time is we remove any non-cash true expenses, right? Like when you depreciate something, you lose value of that asset, which means you lose money on it, but technically you're not really losing any cash out of it. So that's what this non-GAAP is. It's stuff like that that gets added back on to show what the actual monetary value for this company is. So 53.8 million lost this year. So one thing we're going to take a look at is see how much cash this company has in the pit and see if, hey, how long this company can last if it maintains this type of net loss for the next upcoming years. Net loss for the year was $1.09 compared to 76 cents loss last year. That's, again, I'm not happy to see these numbers increase higher loss, but we see that this company is being very bullish on itself by increasing its sales force and increasing the amount. I'm trying to make these sales happen. Cash flow used this quarter was actually a use of $30.8 million. That means this company burned through about $30.8 million for the full year of 2020 compared to a small gain of $5.2 million. So this means that this company is actually losing money from its everyday activities. It's actually losing $30.8 million a year from its everyday activities. Some of the main things that we mentioned already, right, is customer count increased to about 1,900, which is really good, an increase of 38% customers year over year. They announced this new office in Tokyo, and they have YEXT Japan, where they also have appointed a president and COO. So now let's take a look at the full year of 2021. This company is expected to make about 378 million to 382 million. And if we take a look, that is actually right in the mid ballpark of what the analysts estimate this company would make. Non-GAAP net loss of about 50 to 45 cents. And if we take a look at, they estimate a negative 43 cent loss of non-GAAP loss. So we can see we're pretty similar to what the analysts estimate. So I think we talked enough about this company's income statement. So let's jump in with this company's balance sheet. First thing, let's look at cash and cash equivalents. This company has $256 million of cash and cash equivalents compared to $91 million last year. So we see an increase of about $160 million in cash and cash equivalents. Yes, this company did have $51 million in marketable securities where it doesn't have it now. So it increased cash and cash equivalents by 160. Let's subtract that 50. So technically, any short-term assets increased by 110 million, which is pretty good news. This company has higher accounts receivable, but that is expected with an increase in customer base. And again, this is dependent on when the numbers are taken. So maybe some customers are paying in the next week and eventually will drop down to about that $55 million. So again, accounts receivable is something that, yes, it's horrible to see fluctuate, but it all depends on when the payment is actually due from their customers. So total current assets increased by about $140 million. $110 million of that dollars came mainly from cash and cash equivalents and marketable securities, from quick cash. So that's definitely a good thing to see. Next, I'm here highlighting these two assets: restricted cash and operating lease right of use of assets. These are assets this company did not have last year, so we're going to subtract it with the total assets. So that's about 123 actually. So 123 would give these $440 million of total assets compared to $267 million of total assets. So we can see we are increasing in total assets by very good margins. if we compare apples to apples and remove those assets that they did not have last year. Now let's take a look at this company's liability. Accounts payable for this company, I would say, is pretty flat. And again, this pretty much just it's just dependent on when they pay their customers. Right, so they can pay it next week and actually drop this down. So this is pretty much a timing thing, one that I don't really take a look at. But the one that I really want to take a look at is unearned revenue. So last year, this company had $135 million of unearned revenue. This year, it has almost $180 million. So that's showing this increase in customer base, increase in subscription services by almost $40 million. So those are pretty good news. Their total current liabilities grew by about $70 million, 40 coming from unearned revenues. We actually can take about $10 million from this extra liability that they did not have last year. So that means this company's total current liabilities only grew by about $60 million. So we see next. Let's take a look at their total liabilities. So their total liabilities grew by $180 million. But let's take away this extra liability that this company has, similar to what we did with the assets. So that's 115 plus 88, so about 120 million. Let's just say 120 million dollars of extra liability that we can take off would give this company's total liability of 240. So total liabilities only grew by 60 million, where total assets grew by over $100 million. So those are two good things to see, and I'm really happy with this company's cash and cash equivalents. So one thing we did say is this company was burning at about $50 million in cash net loss that we saw here. But we saw that the cash flow from operations, we have to include the total non-GAAP net loss. The total non-GAAP loss for this company was $53 million. So if this company burns through $53 million and it has $256 million in cash, this company can actually survive 5 years without actually making one penny, which I don't think would happen, but it's just good to know how long this company can actually withstand a bad turmoil. One thing that I am happy though is this company doesn't seem to have any real long-term debt opposed from its operating leases. So that's just its building. So it doesn't really seem to have any other type of senior notes or any loans that it needs to pay off. So actually, let's take a look at the company's income statement. So we saw revenue increase by huge margins, $230 million last year compared to almost $300 million this year. And we can see, right, sales and marketing, we can see why their gross margins have decreased, and it's because of these operating expenses. We see, right, sales marketing last year was $160 million. This year was $220 million. So a huge increase in sales and marketing. Research and development increased from 36 million last year to about 50 million this year. So about 14 million increase, and that's good, right? This company is working with cloud systems and it's working with artificial intelligence. So research and development needs to continue to increase, and I'm okay with that expense. Next, we have general administrative, increased by, last year was $51 million, this year was $77 million, an increase of about $26 million. So we can see, right, this company is spending more money right now, but again, it is trying to increase and grow at a higher pace. So total operating costs increased by almost $100 million. Next, let's take a look at this company's cash flow statement. The only real thing I want to see is this company is paying a little bit more on stock-based compensation, about $20 million more compared to the same time last year. And again, we're seeing more employees here, so that's where we would see that increase in stock-based compensation. And like I mentioned, net cash flow provided by operating activities was negative $30 million. And if we're just looking at net cash flow from operations, this company can actually withhold about seven years without actually making money. So that's all I have for YEXT. I am a huge fan of YEXT. The main reasons I am a fan of YEXT is for the following. I think their product is very cool. And based on the way customers are going now with the online shopping and with a lot of Google Trend and Google, people are doing Google research before buying a product now, right? We're no longer in an era where the salesperson tells us, hey, this is the product you need. Now we go to the online and find out what type of product we truly need and why this product does what we need it to do. This company helps that in not only the sales, in that sales world, in the retail world, but also in the food network. And that's why we see like companies like Taco Bell and YEXT and Subway work with them. So I truly believe with their product, and there's not many companies doing this. So it is very nice. It is very impressive to be doing this. Next, this company has a very strong balance sheet. We did see this company's asset was pretty strong compared to the liabilities. I was very impressed by the amount of revenue this company is collected. The only really big flaw, the main big flaw that I see with this company is that it's still doing a loss. But to offset that is because this company has increased the amount of sales force, the amount of generals first, to increase the amount of revenue, right? We're seeing 20%, 25%, 30% revenue growth, which is pretty crazy. And we are going to continue to see that for next year. So actually, let's look at their websites real quick with some of the companies they work with. They work with Taco Bell, Jaguar, Land Rover, Arby's, Marriott, T-Mobile, Ben & Jerry's. And here they show, here if you guys definitely, this is pretty much what this company does. Who is the CEO? So something as simple as that would give you the CEO in the medical device, in the medical realm, right? In the medical realm, a lot of medical companies use this because you can go and be like, hey, looking for a Spanish-speaking doctor in my area, looking for a English-speaking doctor in my area, looking for a Portuguese-speaking doctor in my area, and it would actually give you a bio and a true answer for that. So again, it's something that a lot of companies are gonna need. So yeah, definitely check out their website and see what they experience. So you guys can learn a little bit more about it, or even check my previous video. In my previous video on YEXT, I go around. I definitely talk about the full experience of YEXT. So take care, guys. Have a good night and see you next time.